Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. Have you ever felt that knot in your stomach watching the stock market tumble, especially after you've just invested some of your hard-earned money? Have you ever wondered how seasoned investors with large amounts invested handle those gut-wrenching portfolio drops? Well, in this episode, we're tackling market volatility head-on. Our guest, Marc Beavis, is a seasoned investor who's lived through multiple major crashes over the decades, and he shares powerful mindset shifts and actionable strategies to help you stay calm, stay invested, and stay on track even when the headlines are screaming chaos. One of the reasons that I really wanted to have Marc on the show is that, one, he's been in the industry for decades. Even though he's retired now, he's been working with clients over these decades. So he's got not only wisdom on what has helped him stay the course over the decades with multiple stock market drops, but also what has worked well for others that he's worked with. So Canadians with different personalities and different temperaments. He's also retired, like I said, and he's in his 60s. So he actually has real life experience going through the crashes with a significant amount of his own money invested through it all, like in the 2008 financial crisis and the tech crash in the 2000s, just to name a few. He also runs one of the largest Canadian investing YouTube channels in Canada called Beavis Wealth. So despite retiring, he's still very much on top of what's been happening and what we can do to better handle declines in our own portfolios. So in this episode, you'll learn the mindset shifts needed to endure significant declines and discover some proven strategies for staying calm and confident when your investments plummet. Marc shares what's worked well for him, what he's found to work well for his clients, and I share some of my own as well on what has helped me be calm during the storms, like when COVID happened, for example, and when the Trump tariffs came into play. So I'm sure you'll get lots out of this episode to help you stay calm, make better decisions, and you hopefully get a lot less anxiety when these market downturns inevitably happen now and in the future. Let's get into the interview. All right, Marc, welcome to the show.
Thank you, Cornell. Great to be here with you.
Awesome. Yeah, great to see you again. I really enjoyed our last podcast episode together. And I thought, okay, I got to pick Marc's brain a little bit more here. It's nice to have someone that has decades of experience in the investing world, but is also retired now. So, and you've worked with clients so much over the years. So I imagine, you've got to have a lot of insights. You definitely did last time we did an interview together, both kind of from your own experience, but also from working with clients. So yeah, I thought it'd be fun to pick your brain here, because I've definitely been getting emails about some Canadians feeling stressed because obviously we've had some market declines. Things were looking so nice and rosy for so long. And then, of course, Trump comes in with these tariffs. Things get really volatile and scary. And definitely there's been some Canadians who, they're maxing out their TFSA, their FHSA, and then they see that money kind of, I wouldn't say plummet, but decrease. Whereas we've been used to seeing things go up pretty consistently. So I thought it'd be great to pick your brain on that and how you best deal with it and how you've helped others deal with it. So just to maybe start things off and set the stage, can you give us your background on the stock market crashes that you've been through, and what were some of the worst declines that you've experienced during this time?
Yeah. Well, when you did invite me to have this discussion with you, yeah, hopefully, because I've been through a number of these, and I know a lot of your listeners, maybe been through one or a baby one, or, feeling anxious. So hopefully I can share some perspective and help some people out. But to answer your question, Cornell, yes, I mean, I've been through a number of stock market crashes as an investor. I got into the business sort of mid-90s, let's say. So, my first real experience with a crash was the tech crash, back in 2000. And even now, when you look back, it's hard to believe, wow, it's 25 years ago now, but it does still, resonate with the community in general as sort of being one of the bigger ones. But a lot of people, I only read about that, right? People, didn't necessarily invest through that. What made that kind of more memorable for me, Cornell, was I was a young advisor at the time. So, maybe for 3 or 4 years, I had been an advisor working directly with clients. And so aside from having my own portfolio that I had to ride that out with, I also was responsible for other people's money. And so that adds a whole new level. So I do remember that quite well. couple of things that really stick out to me on that crash, because it was my first one, is, you'll hear this phrase and they say it's the four most dangerous words in investing is this time it's different. And wow, my introduction to the markets and the crash that came about was exactly that. Everybody said, oh, it's all different. We've got the internet now, and of course it was tech driven. So if you were kind of old school and thought that this time maybe it wasn't different, you were just shunned, right? This is like the whole new dynamic out there. And I remember going through some periods where I literally felt, okay, all my training, everything I've read about the investors that I followed are saying it's not different, but maybe they're wrong. And, I think, we saw that we're maybe seeing that now with artificial intelligence, or people saying this is a whole new dynamic and everything is shifted. So maybe those old rules are wrong. So what it did for me after, all was said and done is it solidified those things. And that's really, done a lot to help me as the years have gone by as well. I also learned probably my biggest lesson ever as an investor. And I won't go too much into detail, but I did very well on a particular stock. The company's called Ballard Power, and it went up like everything else did back in the day. And I turned my, I don't know, roughly, this is a good story with a bad ending, but I turned my roughly $15,000 investment, I think it was, into just shy of $250,000.
Wow.
And I thought this was going to go up higher. And so I kept in, and of course the correction came, and it was just a dip, and all the things that people are experiencing now. And I wrote it back down right to the bottom. And now I would take some profits from that along the way. I wouldn't necessarily exit the position, but wow, that was a real lesson in taking profits and managing the portfolio and not just sort of believing in the story. Next one, I guess, the Great Financial Crisis. So more of your listeners probably will remember that, because even that's going back 15, no, I guess 7 or 8. How long ago was that? Oh, wow. That's going back more than a decade, 15 years.
More a decade now. Yeah. Yeah.
Holy
Makes me feel
cow,
older.
Well, I'm amazed. I'm amazed I still remember it as well as I do. It was I remember from that one, that to me had a really big impact. And I just remember being glued to the TV, right? I remember every morning at 6:30 in the morning when the markets opened on the West Coast, the wild swings, the new volatility records that were being set. And it really felt a lot different for me. And again, I had a much bigger book of clients I was working with then. So the worry that I felt then, and I did feel worried, was just these huge firms that were going under, right? It wasn't just like, oh, the stocks are going down. I think of Lehman failing, Bear Stearns. At the time, I had some of my money and a lot of my clients' money in Merrill Lynch, which of course, was taken over by Bank of America back in the day. We had the GM Chrysler bankruptcy, or the bailouts that they ended up going through. So it was a whole different vibe to me back then. And, the financial system was imploding essentially. And if it wasn't for the government intervention, that would have happened. So that was pretty big to me there. Obviously we've got, the COVID crash more recently, but even prior to that, I do remember December 2018. And I'm not sure if people remember that, but there was a big drop at the end of the year. So December, I think the markets were down like around 9-10%, somewhere in that range. And that was the tail end of about a 20% decline. And so it kind of felt like a really crappy way to end the year. And quite often later in December, you get that Santa Claus rally and it wasn't coming about. And, the Fed was at that point increasing rates. And I do feel actually that's eerily similar to what we're going through today. Some of the causes of that were the trade war, the China issues that the US were having there. There's a lot of political turmoil. One thing I remember is specifically is happening again. Trump, who was president at the time, was blaming or criticizing Jerome Powell for doing what he does. So I think there's also a potential government shutdown as well that was pending. So that's always something that the media picks up on and makes a big deal out of. So there was a lot of things that felt there. And I do remember a lot of my clients feeling quite anxious during that. And I can't help but wonder if it was something to do with Christmas is supposed to be a fun time and here their portfolios are dropping. So maybe there was a psychological effect there. And then, of course, COVID. That I'll sort of speak very briefly on that because it was a brief correction. It was a very sharp correction. Nobody knew what was happening, but it was, about a month or so, the markets dropped and then there was a sharp turnaround. So it was challenging for a lot of investors. But one thing that really good that came out of that, Cornell, was a lot of new investors got into the market. And I love the fact, I've always been dismayed at how few people actually invest. So a ton of new investors, took up the challenge to get involved. And then of course, in 2022, I guess when we had a pretty substantial pullback. Those people got their first test, but again, that was relatively brief as well. And then we picked up quite well up until recently. So yeah, from a perspective of what crashes I've been through, I guess a number, and it kind of reminds me is how regularly these come along. Right, we think of these things as though the Black Monday or Black Friday or whatever, but no, they come along regularly, so they're part of the journey.
Mm. And I assume when 2008 happened, that was probably the biggest crash you had to endure, right? In your life so
From a
far?
Well, from a dollar perspective, it was similar, like from an index perspective, similar to the tech crash. In both cases, I'm going to say the S&P 500, the major indices were down in the 50% range. I mean, maybe a little bit shy, a little bit more. But the tech sector, like the NASDAQ in 2000, Cornell, was down about 80%. So that was probably a bigger statistical drop. But 2008 was definitely it was similar. There's a lot of from an actual percentage drop in the indices. Yeah, right along lines there.
And I imagine as well by 2008, you were not just managing your clients' money. You at that point were probably pretty invested as well yourself, right, with your own money because you've had a career that's been going on at that point as well, right? So you kind of get to experience both sides, right?
I did, yes. At that point, I had a portfolio built up, and so I went along for the ride, if you will, with my clients. Now, we can get into this if you want as well at some point here, Cornell. But I mean, I did manage money, right? And we can maybe get into my style a little bit, but I did manage portfolios. I wasn't necessarily just buy the TSX or buy the S&P 500 and ride it out. So during those times, I tried to take advantage of the drops. But there's a lot of psychology involved in that, probably as much psychology as math.
Sounds good. Yeah, the reason I bring it up is I just think it's valuable to have someone that are both experiencing it from the client side, but also with their own personal money as well, right? Because it's one thing when it's your money, it's another thing when it's someone else's. Those obviously overlap, but I think you're in a very neat situation because one, you've been at it for so long, but then also you've experienced both of those worlds. You've talked to the clients, you've heard the concerns, you've heard how some of them got through it. You know how you yourself have gone through it because it's not like you were just managing clients' money. You had your own money invested as well. So you had to also deal with it yourself psychologically. So yeah, so this is where I think it's really interesting to get your perspective on the different ways to deal with it. So when you encountered these significant drops, such as seeing your portfolio drop by, let's say, 20% or more, what sort of thinking or mindset helped you endure seeing your net worth drop so substantially?
Well, that is a great question. And I mean, there's probably a few prongs in that. But first of all, I guess right from the beginning, I because I felt I knew what I was getting into, I believe I was prepared personally for the big drops because I didn't go in blindly just thinking this is great. Everything always goes up. So when the markets would drop, and then another thing I would say as well, and the more money you build up in your investment account, the more this becomes relevant to me. I have always, and I still think in percentages, and I don't think in raw dollar amounts because 20% correction, like we've seen recently, that could be $1,000 for somebody, right? Or it could be $4 million for somebody. And when you focus on that dollar amount, which I've always shied away from because to me it's irrelevant. If you have $100 million, for example, you drop 20%, you're still doing okay, right? Whereas, so I've always looked at it from a percentage. And if you understand the way the ride works, it's kind of like a roller coaster. You go up, well, it's going to come down at some point, right? That's part of the ride. So I would say maybe my belief or my conviction in history has helped me a lot, and I've never really worried. I mean, you have moments where you go, okay, this is a little bit unsettling, but to the point of actually considering, do I make a massive change? Do I get out of the markets? No, I've never gotten to that point. And a lot of it's just my personality, but also this is something that I know not enough people have, Cornell. I don't know on your channel, or on your podcast, whether you've spoken about this before, but I think everybody should have what's called an investment policy statement. In the industry, we call it an IPS. And when I worked as a portfolio manager, that's a mandatory document. When you sit down with a client, you need to go through this. And it's like a roadmap of your investment journey, which is going to look like. And it gives the client a lot of comfort, but man, it has given me a lot of comfort along the way because you set out before you even start what your plan is going to be, and you anticipate if the market drops 20%, this is what I would do. If the market drops 50%, this is the way I'm going to react. And it doesn't mean you follow it necessarily 100%. Like if you're building a house, you have your plan, you might make adjustments along the way. But for the most part, you don't change that foundation. You don't change what you actually believe in. And to go back and review that document. And I lived through this with clients where we'd go back and look at it if they would get anxious, or quite frankly, if the markets were too hot and they wanted to take on more risk, go back to what the game plan is. So I think having an IPS or having that roadmap for me has been very, very helpful over the years.
If somebody wants to make one, let's say they're just DIY investors, they want to make one for themselves, just so that while they have a cool head and are thinking, it's hard to have a cool head when you just lost a few 100,000, right? So so this is something I suspect that's good for it to be written when things are calm. You've been researching this a lot, and now you're in a good mindset to think rationally instead of let the emotions creep in. What sort of things would you recommend investors that want to do it themselves that they include in this policy for themselves?
Well, the most important thing I would think is you set your investment parameters, and that's multifaceted, but it could be something like in any particular stock. This is a big one. What is the maximum number maximum percentage or weighting in my portfolio I will have of a company? Because, I know of people who have had 80% of their money in one stock. And if it's a stock that is doing well, I mean, that's great, but they don't really have a plan. They might start with a big chunk. I don't know, maybe 10, 15, 20% in one company, and it does really well, and that grows. Now, personally, just for a background, I mean, I'm much more conservative than that. I have a 5% target on my companies. I don't want to have a bunch of companies that are 1% of my portfolio because, they just don't, there's not enough, not enough
upside. It's not worth your time.
Yeah, exactly. I do have a target of 5. Now, what I have is if a particular company represents 5% or more of my portfolio, I'm not necessarily going to trim it on day one, Cornell, but I am going to monitor it more closely, right? That, the market will take it up. And so an example, I don't know if we'll get into this, but just, fairly recently, I trimmed back on some positions, and two that come to mind are Apple and Microsoft. The only reason that I trimmed back on them was because they had become more than I felt comfortable with in my portfolio. It wasn't a matter of, I think they're bad companies or, I haven't lost faith in the companies, but just from a discipline perspective, that's my training has told me when it gets up to 7 or 8 or 9%, you know what? Bad things can happen. I don't want to have too many eggs in that basket and trim them back. So I think that's, in an IPS, that's one of the most important things. Another thing is along the same lines is in a sector. If you have, 15 different companies, you might feel I'm well diversified, but they're all in the tech sector or they're all in the financial sector or the energy sector. Well, you're not really diversified, so because sectors tend to, follow each other down. Every company in a sector will tend to do poorly or well at any given time. So part of an IPS would be that as well, saying I want to have like X, 5% in one stock and 15% in any given sector. So that's another thing that's really important too. And then just talk about, things like your risk tolerance. And that's a really tough one because you don't really know your risk tolerance until you've gone through a bear market or a bull market. Then you kind of get a sense of that, but really put it down in writing and that you can go back and visit. So when you are doing really well in a company and you just feel this company's, I've already doubled my money, it's going to go up 4 times, go back and just read what you said. Like you made a very good point, Cornell. When you're in a calm, sane mind, not at the top of a market, not at the bottom of a market, because your emotions swing way too much for that. So those are the kind of things that you would want to have in that blueprint.
And now a quick message from one of our sponsors. If you're traveling abroad, you need a reliable, fast, and secure internet connection on your phone. Not just for safety, but so you can actually enjoy your trip and not constantly be searching for free Wi-Fi at potentially shady locations where often you get an unsecured connection, which can pose a security risk. Saley ensures that you always have an internet connection when traveling abroad and prevents you from being charged roaming fees by your current cell phone provider. Now, you could buy a local SIM card once you arrive at your destination, but that's a hassle since when your plane lands, you've got enough on your plate, and now you have to go hunting for a SIM card provider and hope that they don't rip you off or give you a SIM card that doesn't even work. That's why when I took my kids to Costa Rica recently, I made sure that I had my data needs covered before I left for the trip. It was less stress, one less thing to worry about when I arrived, and especially if there's a flight delay or any issue, I knew I would have data the moment the plane lands, so I can figure things out right away instead of scrambling to get an internet connection somewhere. Saley is available in over 200 countries. They have a 4.7 out of 5 star rating based on over 57,000 reviews. And you can get an exclusive 15% discount on their data plans by downloading the Saley app and using the code BUILDWEALTH at checkout. Just go to your favorite app store, search for Saley, SAILY, and use the code BUILDWEALTH, all one word, when checking out to get 15% off. More details can be found in the episode's description box.
Are you buying Canadian? Well, why not invest Canadian? At BMO ETFs, we're committed to helping you build a brighter financial future because it's our future too. This is our home, and as Canadians ourselves, we know what you need to grow wealth right here in Canada. Visit bmoetfs.com for more.
Is there anything that you would add for someone that's, let's say, a pure total market index investor where they're not picking stocks individually at all? They're just buying the market. Maybe they have an asset allocation ETF that they like.
Yeah.
And they're just buying that. Because I imagine these psychological rules would still be helpful in that scenario to help prevent things like panic selling when the markets drop 20, 30, 40%, that kind of thing.
100%. And I would say that for most investors, most DIY investors, an ETF, I'm going to use that generically, is the route to go. I think managing a portfolio of 20 or 25 or 30 stocks is really hard for most people. So I don't recommend going that route, especially for, newer investors. But as I mentioned, and just as an example, we talked about the great financial crisis, 2008-ish. I don't know the number off the top of my head, but roughly 45, 50% were the drop in most of the major indices. Well, people are buying a broad index just thinking, okay, well, I'm just going to buy and hold it, and it's going to keep doing anything. It's always gone up. And yeah, but when those times hit, wow, it can throw you for a loop, and you can lose a lot of faith in that if you haven't prepared. And this is where you get back to your policy statement where you say, look in history, every 10 years, the markets do this. So when that happens, how do I feel I'm going to react? Am I going to just let it ride? Am I going to buy in, buy the dip, as people would say, or sell and take some profits. Hopefully before the markets drop. Those are things that I think for an investor who isn't interested in picking individual stocks, I think those are, psychologically, I don't think there's really a difference. It's just more work to manage a portfolio. Personally, I just like the control of having the nuances of creating my own portfolio. But again, it's a lot more work. And another thing that just comes to my mind is if you have individual stocks, and let's say a year goes by and you look and one of your companies is down 25%, you're going to notice that. You can have an ETF that goes up 10% in the year, you're happy with it, but within that ETF, there can be a company or two or three that have dropped by 25%. It doesn't have the psychological damage because you probably don't even know that. You just know the bottom line. So that's another benefit of having a basket of investments that the ETF offers. That's those are my thoughts on that.
That's great. Yeah, I find one thing that's helped me psychologically just recently with, obviously we've had the drop with the tariffs coming in and things of that nature. And again, this will not help someone in every scenario, like if there's like a 50% crash or something. But what's helped me personally, just in case it's helpful to the listeners, is I compared this to like 2008 and what happened then, and compared it to even COVID, right? Where it's like 30-ish% depending what you're invested in of a drop. And so I'm looking at, when I checked the markets recently, I mean, at one point it was the international ETFs were down like 10, 15%, depending what time frame you're looking at. Look, like total market index investing I'm referring to. US was down even more, but still like below 20%-ish. Just again, kind of ballparking here, but that's kind of what it was. And so I look at those drops and I'm thinking, hey, remember when it was 30%? And then I think back to 2008. Hey, remember when it was like 40, 50%? So we all survived then. We saw the markets recovered then. And so here we've got this sort of thing that's happening. It's still obviously not pleasant. It's not fun to see your net worth go down, but just realize that we've been through worse and things have worked out. And so it's helped me kind of put things in perspective. And I'm trying to think of this from a perspective of maybe a brand new investor, because I find I've been, I would say, very calm in this whole tariff thing, the market's dropping, but that's because I've been kind of around the block a few times now with these things. But I can see for like a new investor, that maybe just started. Let's say they just maxed out their TFSA and then their partner maxed out their TFSA and they've been trying to max out the RSP, and they're all of a sudden seeing, they worked hard for this money and now they're seeing thousands it go down by
Yeah.
thousands. And it's like, hey, I worked hard for that. It's gone now. What's going on? And so if that's their first time going through this cycle, I could see that being stressful. But like I said, I think it's helpful to sort of get some context and perspective where, look, it's been a lot worse than this. There's been the Great Depression,
Yeah.
the tech crash, banks failing in 2008. I mean, really, really significant things. I would argue more significant than this tariff situation that's happening. And so I don't know. I just thought I would share that because that's helped me sort of get some perspective. I do love your advice about looking at it as a percentage and not dollars. Because I do find it more painful when I see it as dollars. Because it's like, hey, I could have bought a house for that. What the heck, now it's gone. So I remember I had that go in my head a few times, and maybe not a house now because house prices have gone up so much. But I do remember, when you see it and the amount go, and it's like, hey, that could have paid for like your kid's education. But again, like you said, to view it, look at it as a percentage. But for me, it also helps to compare it to previous periods and say, hey, we've been through some wars and the pandemic, like really huge things, and things survived and we were able to thrive. And those that did not panic sell came out ahead. So let's just remember that instead of just looking at this current situation in a vacuum and just looking at the dollar figure, which that's, again, I like your advice there. Like, don't do that. Yeah.
Well, it is funny because, online you'll read comments and this is, I love new younger investors who are just starting and have $2,000 invested, but you'll read a comment like, well, I lost $200 this month, and but that's the same percentage, right? And it's real that the emotion and the fear. And I think what you just talked about, Cornell, is just having gone through it. And, this is life, right? You learn from experiences. And, I tend to think that financial aspect of your life is extremely important because we do need money for things we do. You don't need to be billionaires, but for normal lifestyles, it's costly and it's getting more and more every year. So you do need to have a basic flow of cash coming in. But it can be challenging out there. And if you are just going through it for the first time, it kind of makes me think, there's a saying, I probably won't say it exactly, but it's basically, if you aren't prepared to hold this investment for 10 years, don't buy it. Or, don't invest money that you can't afford to lose. And those are real things. And so even if it's a small amount or a big amount, if you've just maxed out your TFSA for the first time, let's say you've got a chunk of money and you put it in there and now it's down 10, 15, 20%. I'll go back to, you should have known that that's a real possibility before you even get in. And then we do have this, straight line extrapolation where whatever's happened recently, you feel is always going to happen. So it's down 10, it's down 20. Your brain automatically, because we're humans, goes, oh, now it's going to go down 30. And, I remember sitting with clients who may have lost, let's say 15% of their portfolio. And these would be like literally, Cornell, multimillionaires who say, well, what if I lose it all? And you're invested in good, solid companies. Like if the entire world broke, I guess that's a possibility, but it would be the least of your issues then. But literally your brain could trick you. And what if this never ends? And it's just so much, the human brain plays such a huge role in investing.
Yeah, for sure. Yeah, one thing I wanted to make a distinction of as well, because there are investors out there who will actually pick individual companies. They'll buy the individual stocks. And obviously there's lots of different investing camps and styles, but just generally speaking, one is sort of that stock picker where we are actually buying individual companies. And then there are the other style, which is what I do more so, is the just buying the index as a whole and not picking individual companies. I find at least what's given me a good relief from any anxiety is by being a pure index investor. I can just look at the index over these major things like the pandemic, like 2008.
Yes.
And I just see, here is how the index has done and here's how it recovered. And so by seeing that history of that has personally given me a lot of anxiety reduction, even elimination completely, when we see something like, oh, my portfolio fell 10%, 20%. Well, let's see how it's done in the past. And it made me feel, by being an index investor, it's made me very confident. To your point that you just mentioned, how, well, it's not like all the companies are going to go bankrupt all at once and you're going to lose. It's not like you're investing in some startup company that could go to 100, that could go to 1 billion, or it could go to zero. You don't know, right? When it's an index, it's not like that. It's very, very different, right? You're not going to have Google and Amazon and all the banks in Canada all go bankrupt at once and you lose all your money. So that's personally helped me with not getting anxious and not panic selling and things of that nature. But for you yourself, you have more experience than I, particularly when it comes to picking individual stocks and actually placing these bets on your end. So that kind of thing that I used to make myself feel better as an index investor, I don't know, it seems like that doesn't necessarily work when picking individual companies, because that company could actually go bankrupt. Like it actually could go to zero, and you invested, like you mentioned, like if someone has like 70% of the portfolio in company X can actually go bankrupt, or it could fall down to a really low price, never to recover again. There's no guarantee that it's going to come back to previous highs. So how do you arrange that in your brain? Because sometimes people just think buy and hold. And I'm like, well, yeah, if you're a total market index investor, that makes sense. To me, at least, like that's what I do. But if it's a company, then it's like, well, hold on, maybe something fundamentally has changed at that one specific company you invested in, and maybe it will not recover. So buy and hold might not be the best strategy, because there isn't, like, obviously there's never a guarantee, but you know what I mean, right? It's less certain what will happen if you're looking at just individual companies. So how do you deal with that? How do you think about that for all the people listening who also like to dabble in individual stock investing as well?
Well, a very, very solid foundation of the psychological, the differences between, because you're not going to see really an index go to zero. Now, a broad index, because, hey, I was working through when the pot stocks were their rage. And essentially you look at, those, I don't know the tickers on them, but some of those companies that bought a diversified portfolio of pot stocks, well, they're down 95%, right? So they've essentially gone to zero. The underlying thing with everything that you've said, Cornell, there's an assumption that what you're buying is a quality company, and that's harder to quantify. But for example, I mean, I've owned Coca-Cola for as long as I can remember. I've owned Johnson & Johnson for as long as I can remember. Now, each of these companies have gone through their trials and tribulations, and they've been out of favor and back in favor. I don't see Coca-Cola just going bankrupt, in May. If it did, and I don't know today what my percentage of the portfolio is, but let's say it's 4%. Yeah, my portfolio, if it closed tomorrow with no residual value, my portfolio is going to drop 4% from that one company. So I can live with that. Even if 3 of them went out of business tomorrow with no residual value, I'm going to take a 15% hit on that. And generally speaking, if you have a diversified portfolio, and I've watched with interest over the last month or so as we've seen the correction in the major indices, and I look at my portfolio every single day, something's down, something's up. Right? There's every day there's something that goes up, because that's just the way the markets work. If you have diversification in your portfolio, things that aren't correlated, things that the sectors, companies that do different from everything else in your portfolio. So as an investor who buys individual companies, very aware. Now, it's never happened to me that a company has literally gone bankrupt. Again, I try and buy quality companies that have been around for 30, 40, 50, 100 or more years. Anything can change, and history is littered with companies that have gone out of business. But in most cases, if they go through a rough patch, they're acquired by someone else. You don't lose all of your money. You might get 50 cents on the dollar or something. So it's not a concern that I have. But again, this is what I did. It's like, I guess it's kind of like a pilot flying an airplane. When you hit turbulence, there's a lot of people in the back who are going to be frightened by this turbulence. The pilot's going, oh, I go through this all the time. It's not an issue. I'm fine with it. And it's sort of the same thing again. That comes down to experience. Now, I think you mentioned, Cornell, if you're mostly, well, I don't know if you said this exactly, but a lot of people have mostly ETFs, but like to buy individual securities as well. Absolutely. I love that concept. If you're interested in going that route, the core of your portfolio is that index, it's the ETFs that are broadly diversified. But hey, you want to buy shares of whatever the company is. Yeah, but do 2% of your portfolio to learn the ropes. Maybe do 5%. This is where you go back and set up what you're comfortable with and buy it with the understanding that, well, this company could go through a really bad patch and I could lose the majority of this money or possibly all the money. Again, I get some people make a lot of money by speculating. I don't speculate. So there's I think you said this earlier, you can make make a lot of money, or you can lose a lot of money on those more speculative bets.
Mhm.
So I think those are more for the real pros who do that all the time, and not for the average person on the street. Again, I know a lot of professional advisors out there, and that's very rare that you would see someone dabbling in that type of investment, and there's a reason for it.
Yeah, it seems like it's important to make these distinctions because I'm just thinking back, even I'm kind of dating myself, but even back in your high school days, and maybe some people experience this now too, like a high school student, they learn about the stock market and what they'll probably get exposed to first, I would think, at least I did, was, the penny stocks where
Yeah,
let's buy
yeah,
this penny stock. It could go to the moon. You could make all this money, get rich quick, all that kind of stuff. So I like your point about how, okay, so that's one type of investing is where, yeah, it could go to the moon, but it could also go to zero. And then
right.
we go down the spectrum, I suppose, and then we get into maybe your type where, okay, yes, you are buying individual companies, and yes, an individual company could go bankrupt, but like you said yourself, you're picking companies like the Coca-Colas of the world or the Microsofts of the world, the Apples of the world, where the probability of that happening is way, way, way lower than, something like some startup pot stock
Yeah,
or something
yeah,
or whatever, or, tech stock. And so
absolutely.
then
Yeah,
the probability of losing all your money, is much, much lower. And then you kind of go further into this on the spectrum. And obviously there's things in between, but I mean, and then you get into the kind of other spectrum where it's more, I guess, how I invest, where we're just buying total market index investing. And there's even more certainty there that, okay, not all the
yeah,
companies are all of a sudden go to zero and you're going to lose all your money. Because I remember, yeah, when I learned this for the first time, for that first experience back in high school, it was easy to think, oh, this is just how the stock market is. You put your money into a company and you could lose it all. And if you don't feel comfortable losing it all, then maybe you shouldn't invest. And it's like, well, hold on, there's different types, right? It's not like you shouldn't invest at all then because you had a bad experience with a penny stock. You could still invest, just maybe you pick the more stable companies, or maybe you just do total market index investing where you're not going to just lose everything potentially, right? So because I think that maybe is a fallacy that I fell into back in my high school days
Mhm.
before I learned all this, that there are different flavors, so to speak, right? And you're talking about the kind of stable stock picking flavor. We cannot treat that the same as some penny stock that has a good chance of going to zero.
Well, you're right. And something that comes to my mind there, and just as an aside, that's how I sort of got involved as well as, when I was, I guess, in my early 20s, I suppose. I was a regular buyer. I was a saver starting from 18-ish or so, but my first real foray into the investing, the markets were penny stocks. And it was a good lesson for me. And I'm thankful. I mean, I had a very small amount of money to invest, but after a few months of that, I kind of broke even. I made some money, I lost some money, but I learned really early, this is not for me. Like, it wasn't fun. It was stressful. And so that's kind of, I guess, sort of what steered me in the direction, even as a younger person, to a more stable type of portfolio. And I think for most people, that kind of does well for you over the decades. And that's something we haven't really spoken about, but we've kind of alluded to investing being a long-term game. And we know what happened today or what happened last week isn't indicative of what's going to happen going forward, whether it's really positive, like I made a bunch of money, or whether it's because I lost a lot of money.
So you're retired now, but back in your working years, you spent the decades working with clients, helping them get through these difficult stock market drops. When you encountered, and you touched on this already, especially for yourself, but when you encountered a client who was anxious and distressed
Mhm.
about seeing their investments plummet, what have you found work well in terms of advice you could give them to calm them down, reduce their anxiety, and make sure that they don't actually panic sell?
Right. Great question. And I know people are going through that right now. The first thing I'll say on that topic, Cornell, is I mean, this is what I truly believe. The level of anxiety or euphoria that a client is going to feel that's inherent in that client, right? There's some people who just, it doesn't matter what happens, are going to be anxious about it. They need a lot of hand holding, a lot of comfort. And you know what? I mean, I'm just thinking from the perspective of a former advisor here. For those clients, I mean, the day that the market would start dropping, pick up the phone and call them, just check in. And even if they know you're there for them, or if you're a DIY investor, you don't have the benefit of that, I suppose, but just, I'm not alone in this, right? And I think that's, it's a human brain. If there's something traumatic that's happening, you just want to make sure that you're not the only person out there worrying about it. I do recall a client one time going through a bit of a challenge, and we talked about her worries, and she said, because I was trying to calm her down, and she said, "Mark, I worry about worrying." It's just, she was just a worrier. And I remember her saying, "I worry that the foundation of my house is going to crack, and there's nothing wrong with it." But that's her nature. So I think, again, in cases like that, being there, hand holding, and again, I'm speaking from the perspective of a advisor. One thing I would do regularly, I'm going back to this investment policy statement. You go back and say, yes, right now you're feeling anxious, or in fairness, right now the markets are doing really well. And I know that you heard that you need to buy shares of Nvidia, and we don't own them. So, well, I want to buy those because they've done so well. Go back and revisit that battle plan. And that really is very helpful. I also, for certain clients, I mean, with every client I would suggest it, but with certain clients I would kind of almost enforce it, is journal. Just, I had a binder, like a little booklet kind of thing that I would give to every client at the outside of our relationship. And go down, and if you're feeling really bullish, or if you're feeling really, anxious, just put your thoughts down, because those times will come back. And if you have that resource to go back and go, like, even if you're working without an advisor, so DIYs can do this, put it down and go back. Oh, wow. In 2018, in December, I remember, I was feeling like that. Yeah, I'd forgotten about that. But now, oh yeah. And you know what? Everything worked okay. This is what I did. That can also provide a lot of comfort, just so that, you're not sort of flapping out there in the wind,
That's a great, I'm thinking through, like, let's say someone was investing during the COVID, and now that's recovered, things have gone well, and they've been journaling then. And then now they're starting to feel themselves anxious now, or during these tariffs, where the drop has not been as significant as during COVID. I could see how if you had that journal and you go back and you're like, oh, this is how I felt during COVID, and I weathered that storm, then it kind of puts things in perspective, where it's like, well, why am I freaking out now about these tariffs? This is clearly not as significant as what happened with COVID. For me personally, that would give me some comfort, where it's like, hey, remember when you weathered that storm and you check out that journal? That would make me feel less anxious, because now we have a smaller storm. You know what I mean?
And these are your own words. This isn't someone telling you.
Exactly.
These are your own words, and that's really powerful. I mean,
more effective than some blog posts you read online that everything's going to be okay.
Yeah, much more effective. And I mean, I do have my book that I've had for all these years, and I mean, I don't journal as much anymore, because I've kind of feel like I've gone through all of the range of emotions, for the most part. But I do go back, and I enjoy looking back at just the evolution of an investor, and that can be very valuable. One last thing I will sort of say on this topic that comes to mind here is this, and I think we just alluded to sort of a blog post. And one thing that, I mean, it's one thing to say, the markets always recover, or, don't worry if you haven't lost, if you haven't sold, and those types of things. Those are truisms, I would say. But I found with clients who were particularly anxious, they didn't provide a lot of comfort. They weren't deep enough. So those facts, combined with a more emotional aspect to it, like you say, going back and looking at your journal, I think when you combine both of those, so you have the factual part of it that says, yep, the markets have been through this before, so I can see on paper they recovered, but I'm still not feeling well about it. Then, combine the psychological aspect of it as well is even more powerful.
And now a quick message from one of our sponsors. Are you approaching retirement and wondering how to turn your hard-earned savings into an income stream? Introducing Sun Life's My Retirement Income Solution. This is available for those who have or have ever in the past had a Sun Life group savings plan through your employer. This solution is created for those who are nearing or in retirement and want to receive income tailored to a target age. How My Retirement Income works is that you pick a target age you want your money to last until, such as age 85, 90, 95, or 100, and then the solution offers a unique blend of income and growth potential to help your money last until your chosen target age. This automated process eliminates the need for repeated reassessment, and with this solution, your payments will be deposited directly into your bank account while still having the opportunity for your investments to grow. It provides flexibility, allowing you to have access to your money at any time without fees or penalties, along with an easy transfer to leave a legacy for your loved ones. Sun Life's licensed retirement consultants are ready to guide you through the process. To learn more about if Sun Life My Retirement Income is right for you, visit buildwealthcanada.com. buildwealthcanada.ca/myretirementincome, all one word, to schedule an appointment with a Sun Life retirement consultant today. That's buildwealthcanada.ca/myretirementincome.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
I like your point about thinking that, okay, not everyone has the same sort of temperament. Some are more anxious than others. Some people will need that supportive financial planner, like a fee-for-service financial planner that can help them alleviate the stress. Because I know on this podcast, and I know myself personally, I'm very much DIY, but I interview a lot of financial planners. But for me, I feel like I can weather the storm alone. Whereas I like your point about how, okay, maybe not everyone can, especially if they're new to investing and it's their first time going through it. Maybe they're not a giant nerd like me where I've been reading this stuff for so many years. So, which can help with that anxiety as well, just understanding it. So yeah, it's an interesting point about how, okay, yes, you could get the lowest fees by just doing everything yourself, being a purist DIY investor. But then if you feel you're not going to do the wisest thing when these storms hit, maybe it is worthwhile paying some money to a fee-for-service financial planner, or working with someone like a professional. Like I know you're retired now, but like in your case, someone that has gone through this before, they've seen this, what happens. They know these different psychological triggers that can cause people to panic sell. Maybe have someone like that, kind of like a shrink, but for your finances, right? Yeah. I could see that being really, really valuable because, like you said, right? Some people are just very anxious and they need that.
I can't count the number of times where a simple phone call just to check in would give that client comfort. Even if we're not doing anything to your portfolio, the best thing right now is just to sit where we are, or we're making some adjustments. But just that you would hear the relief come out of their voice, like I would earlier, like someone's flying the ship here, right? And it doesn't fall on their shoulders. They're not having to make decisions as to what to do, and that can be really, really valuable. Yeah. And I think you said it goes down to the individual. Another thing that just came to my mind too is a lot of people would say, well, gee, if you're older, you have to be more conservative. If you're younger, you have all kinds of risk. It's not age dependent. I learned that. I mean, there's younger people technically can afford to take on more risk, but a danger is if they get scared out of being an investor because they have a bad experience and 10 years goes by and they've lost a whole decade of opportunity for growth. And then they go, okay, now I feel comfortable again. Ironically, that's usually because the markets have done really well. So they're going to go, I feel comfortable now that the markets are hot again, which is probably a bad time to get in. Well, not the best time to get in. Let me put it that way. I think getting in is always good. Being an investor is better than not being an investor, but that's another thing too. So, I mean, I had clients in their 70s and even 80s who had quite a high tolerance for risk. Whereas I had, younger clients, especially early in my career, that, were anxious. Like, again, I think you said, kind of comes down to who you are as a person a lot of the time.
That's right. Yeah. It's like mathematically, yes, you can take on more risk as a younger person and an older person. Yeah. But again, that's mathematically assuming we're all robotic and no emotions are involved. But then the human element comes into play. And yeah, like you said, there could be someone in their 80s with a very, very fixed amount of investments, right? Not much, maybe not much earning power anymore, depending on their situation. Yeah. And they're cool as a cucumber versus you got the 24-year-old in a high-paying job, their whole lifetime ahead of them to earn a lot of money, and they're twice as nervous, right? I could, because Correct. Again, the whole human element, Very, very interesting point. That's awesome. So now that you are in retirement, I recall last time we spoke that you have adjusted your portfolio to be less volatile during market downturns. So in other words, instead of fully optimizing for maximum growth, you've shifted the portfolio to focus a bit more on lowering its volatility and preserving your capital during downturns. Can you speak to your thought process when doing this type of shift to your investment portfolio, maybe going from that accumulation stage to now decumulation stage, securing your capital from this volatility, or at least helping to offset some of this volatility?
Yeah, I mean, you touched on the stages, and when you're younger, generally you're in the accumulation stage, right? You want to grow that portfolio. Then you get to where I am now, and there is more of a shift to preserving the capital right now. It's not exclusive. because I do hope to be around for a while yet. And I always like having that growth. I mean, inflation isn't going anywhere. So I don't think you really, unless you have, more money than you can ever possibly spend and are comfortable with it, I don't think you should get to the point as an investor where you just go, okay, putting it all under the mattress and I'm okay with that. When it comes down to that, and just personally, Cornell, I will say, I don't think it's a whole bunch of brain work. I'm just following my plan. And I kind of touched on earlier where I de-risked my portfolio a few months ago, not because I knew we're going to have a correction, or not because I knew Trump's going to put tariffs on, or whatever's causing the turbulence out there. It's just I looked at my plan and I went, wow, these companies are trading. They're more than I want to have in them right now. So my discipline forced me essentially to take some profits on those. And in, the cases with Microsoft and with Apple, turns out, okay, that worked out well. Now, I was fully aware too, and, I'm on the Blossom platform. I'm not sure if many of your listeners are on the Blossom platform, but my portfolio is on there. And, you can get comments of saying, well, this is a really good company. It's going to go up higher. That wasn't my concern. My concern was something bad happening and it going down. I just wanted to take that, if it went bankrupt, I don't want to lose 8% of my portfolio. I want to lose 5 kind of thing. Right. So I didn't reduce or eliminate these positions. Rather, I just reduced the weighting that I had. So kind of goes back to that, the blueprint that I have where I have a 5% target, 15% in the sector. I added a little bit. We can maybe get to that. But what I did was I liked to make sure that my portfolio was more heavy in, I think of it like the things we use every day, right? We eat food every day. We use certain toiletries every day. Food, the consumer staples sector, they're not immune from market drops, but generally speaking, they will drop less when we have a crash than, whatever's leading the sector up. But consumers rarely lead it up. They're sort of in the middle there somewhere. And I thought of this earlier, I didn't really say it, but I'll quickly interject it now. If you manage your own portfolio, whether it's individual securities or even say, instead of just a broad index, you may have maybe 5 different ETFs that are special in each sector. If they're balanced properly, you're not going to do as poorly when the markets crash. You're also not going to do as well when the markets take off. You're going to be somewhere in the middle. And if you're comfortable with that, chugging away as opposed to making a ton of money or losing a ton of money, then they can work very well there. Just thinking here, this is maybe a quick aside here, but there was an advisor when I was working in, this goes back to the great financial crisis, who strayed from what he should have been doing. And he, financials were on fire before they weren't. And I know anecdotally, but I know this happened. He took a massive bet on financials, global financials, with his clients' money. Unfortunately, I'm assuming his as well, and ended up exiting the business because he just, didn't have, I'm assuming he had the discipline, but, got carried away because that's where you want it to be. And there's a big challenge, both professionally, but also for individual DIYers, because you hear other people talking about their stocks that have done really well. And there's that FOMO, right? You want to move into there. And it's true with the advisor community as well, because, people shop around. For many people, the bottom line is the return, and you might get 8 and the other guy gets 10. Well, they're going to shift their money over. So you want to keep those clients as long as there's a good fit. So that's something. And with individuals, I know a lot of people, it's probably more rampant with individual DIYers because you're online on social media, you're seeing the companies that have done really well, and you're an idiot if you don't own this. And then that's how, if you don't have that blueprint, you can get really messed up in that regard in a hurry.
That makes sense. What did you switch to when you switch from the phases of being fully focused on growth to now having some protection, having some less volatility?
Yeah.
What about on the non-stock side? So whether it's bonds or GICs or money market fund, and things of that nature, which again not optimized for maximum growth, more so so that, hey, if you're retired, like in your case, you still have cash flow coming in for groceries, even when the markets are tanking, things of that nature.
Yeah, great question. And the short answer to that is most of in the last few months when I've trimmed companies, I've just kept it in cash or like a cash equivalent. So, let's say, I don't know, high interest savings account or somewhere along those lines. That's kind of the bulk of it because, since January-ish, I've just felt the markets are way, way, way too overvalued. I'm speaking very broadly. But when you look at the major indices, including the TSX, which is still there now, I believe that they're way overvalued. So logically, it didn't make sense to me to go, okay, part of my brain says, this is too rich here. I'm going to take some money off the table and I'm going to put it back into something right away. I'm by default, because the markets have done well, the majority of my portfolio is in equities. So some of that I was just happy to park in cash. I did put a fair chunk of money into some U.S. treasuries, some long-term U.S. treasuries a number of months back. And the logic there, Cornell, is they should act counter to the stock market. They're typically non-correlated. And also with the longer term duration, I don't want to get too technical here, but we saw interest rates starting to come back down. Now, using history as a guide, that type of investment should do very well. Even for a fixed income investment, it should do quite well. In fact, in many cases, it outperforms equities. Now, that hasn't really turned out with all of the turmoil that we've seen, and the U.S. treasuries have been battered around like a piñata. So there's been a lot of ups and downs there. So that investment hasn't paid off yet. It's probably, minor, like the capital price is probably down, but because they're paying the yield into the portfolio, a small gain there, not nearly as much as I would have thought. But I don't go into anything with a 2-month window or a 3-month window or a 5-year window or 5-month window. I'm always going to have a longer term chunk of that, longer term time horizon in any event. So yeah, mostly cash. And, interest rates over the last couple of years have been pretty attractive. A good place to park your money. For my Canadian money, I've bought some XFR. That's an iShares floating rate index ETF. So it's pretty close to a cash equivalent. It's not cash, but it's a very low volatility. So I was happy taking on that little bit of risk, putting my money there. TFLO, that's an iShares Treasury floating rate bond ETF for my US cash. So just, again, sort of more of a parking money type thing. The only equity position that I've taken in the last while here, this will go back probably to last year, is I did buy an equity ETF. I think probably my first equity ETF, maybe ever, or certainly in many, many years. And in a background, I've always been a big holder of Canadian banks, American banks too, but right now, last number of years, I guess since the great financial crisis, mostly Canadian banks. And I've always sort of gone with bigger is better. When it comes to that type of thing, if there's a big failure, the strongest will survive, and they'll, usually come out of that even stronger. So for years, I've had Royal Bank and TD Bank as my top financial holdings. And of course, TD Bank has gone through a real tough time with all of their scandals and south of the border. And what I did, staying in the sector, but I just added some money to a company, or to a ETF, actually. HBA is the ticker. It's the Hamilton Australian Bank Equal Weight Index. And this is an Australian-focused financial ETF. And when I looked back and did my research on it, it complements the Canadian holdings very, very well. So I did feel comfortable putting some more money in there. Like I say, I always like to build up that portion of my portfolio. So the difference, I guess, instead of putting money into the Canadian banks right now, I put the money in there. And so far, it's worked out quite well.
When it comes to that cash portion you were referring to earlier and having some money in there, what was your thought process when deciding how much cash to put in, right? Because obviously the more, especially being in retirement, the more you put in there, the more that can sustain you just for lifestyle expenses, things of that nature. But then, of course, there's the opportunity cost. The more you keep in there, the less there is. It's not going to grow the way equities have over the long term. So how do you decide what you do or how much to put in? What was your thought process there?
Yeah, my main focus right now is not growing. It's not, I still have most of my money in the equity markets. So, but it's not like trying to maximize that growth. It's getting slammed on the downside. That's what's more important to me right now. I have sufficient assets that I don't really have to grow my money, but I enjoy the markets and I still think it's the right thing to do. So the majority of my money, I think, will probably always be in the equity markets. So as I've reduced the risk exposure, I've just put that into cash, or like the short-term bonds. I'm going to call that a cash equivalent, just until the markets come back to a valuation that I'm more comfortable with. And I get it. This is sort of the dreaded market timing, and I look at market timing, if I say, oh, I'm all in cash, right? I've sold out of equities. You hear this, right? I sold out of equities, I'm in cash. Or, I'm all in equities, and why would you hold some cash? I don't think there's ever a time that you should be all or none. I think that the degree would vary. So right now, I have a higher cash position that I would normally have. But that said, I think it's warranted just because the markets are so highly valued, even with the most recent pullback. If you look at it just from a valuation perspective, the major indices, they are still high. So I think there's still room on the downside. It'll be volatile. But you know what? If the markets pop 20% the rest of this year, I'm okay with that. I've got, most of my money in there too. I'm going to miss that opportunity. but I'm more concerned about getting hit too hard on the downside. And, I saw that too many times, both, certainly for someone who's a senior and retired, that's more important. But also, I always hate when you have, let's say, a 30-year-old who becomes, too aggressive, and they got lots of time to recover, but also, I don't want to pick a number. Let's say you got $50,000 invested. Well, if you lose 25,000 of that because you're in a stock that goes away or drops that much and doesn't come back for 10 or 20 years, well, that's opportunity cost too, right? So, we always refer to the snowball, and, the goal is you start with something small and you build and you build, and then 10% of a bigger number is 10% of a bigger number, right? And so I always hate when that goes down too far, an unnecessarily far drop, because you got time, but you're also starting back, right? You're taking 3 steps back as opposed to taking smaller steps from a forward position.
When you're deciding how much cash to have on the side there, do you do something like a percentage of your portfolio? Do you look at it that way, or do you look at it more from the expense side? Like, my expenses for just day-to-day living are this much, let's say, per month or per year, and therefore I want to have this absolute amount in dollars as kind of a cushion in case we have another 2008. Do you look at it that way, or do you just kind of look at, okay, I feel markets are overvalued, or they have high valuations now or low valuations, and therefore I'm going to do this percent in cash? How do you, which one of those do you pick, or do you pick something different in terms of your thinking?
Yeah, no, great question. And that's a very common thing that you do in retirement, is that you have, a bucket kind of thing where every year or every 2 years, you take money out of your portfolio and you have enough in there to provide for your expenses for the year or for 2 years, right? So you're making a trade-off. You're saying, I'm foregoing any possible growth here, or, taking a small number. And over the last, 15 years, it's been a very small number, but still it gives you that peace of mind. Okay, if the market's correct, I do still have time to recover on that regard. So, but personally, in this case, no, I've got cash set aside that I can live off of for a while. So this is more the portfolio that I have invested in, that portion. And I think, I segregate them, and I go, I've got cash set aside here for that. If everything went away, right? Worst case scenario, everything dropped 80%. I'm going to carry on with my day-to-day living from one chunk of cash. This is the cash from within the portfolio itself. And I don't even know today exactly what that number is. I just know that as I've trimmed, I've left that in a cash equivalent. I don't know if that answers your question, Cornell. So it's not as scientific as maybe it could be, but my main goal right now is just to reduce the risk. And so inherently with that, at least using my strategy here, I'm going to increase the cash. If I drop 5% in equity weighting, I'm going to increase 5% in cash. And I'm okay with that until we get through this rough patch right now.
Gotcha. Sounds good. Is there anything that you were hoping we could cover today that we haven't spoken about yet?
Well, that's a wild card out there. I said I could do this for 6 hours, right?
This is going to turn into like a 5-parter.
I know I said this earlier, but I'm just so joyful, Cornell, to see how many new investors we have out there. And for my entire career, I've lamented how few younger people, so I'm going to say 20s, 30s, even cared about investing. And so we're seeing a real shift there, I think, and I want the experience to be really good. That kind of takes me, I guess, to social media, because, when I started investing, I remember having in my home office, like a filing cabinet where you had the booklets of different types of investments, and it was all paper-based, and, the access to information was proprietary. I mean, if you wanted to learn about a stock, you basically went to your stockbroker or to your investment advisor who had the information, but you couldn't get it online, really. Even the big financial channels worked around then. So from a social media perspective, I look at it like fire. It can be very, very beneficial. You're cold, you need to cook some food, you make a fire, but it can be extremely dangerous. And that's a part of social media, let's call it meme stocks, that type of thing, that really trouble me right now. So that's something I would caution anybody, but especially younger investors who are more into that type of thing, to just be very careful and understand what you're buying before you just, take the plunge and get in there. And I think the biggest thing that we did touch on it, but I just want to sort of wrap this up and say the behavioral finance aspect is, to me, the most important part of investing. I'll quantify that. I'll qualify that. Investing is the most important thing. Starting and putting whatever you can, ideally on a systematic basis, whether it's every paycheck or once a month, but just having the plan where you pay yourself first. You cannot overemphasize how important that is. And I think that some of my clients who created a lot of wealth over the years never did anything particularly special. We didn't buy any major stock that blew up and, turned them into multimillionaires overnight. They didn't make high incomes, but from an early age, they just invested. And it's shocking. I mean, I have the benefit now of looking back 20, 25 years and going, wow, this company I've owned all those time and look what it's done. Nothing because I did anything special, but just because you had a skin in the game, right? So behavioral finance, understand who we are as human beings, why we make the decisions that we do, how our brain works to make those decisions, because that will blow up a portfolio if you make the wrong decisions, or if you're scared and sit on the sidelines for too many years. That's probably the biggest thing. And have a relationship with your money, but money's very personal. But how am I going to say this? When bad things happen in the markets or really good things, don't take it personally. I don't know if that makes sense, but the way my brain thinks is this. And, for those of you who are listening who have children, children give you challenges throughout the years. There's great days and there's really, really tough days. And then they get to the teenagers and there's even tougher days, But one of the things I did very early in my life as an adult, I guess, before I had children, I was a big brother. And the training that they give you, I remember a sheet they gave me that said, hey, Christopher's 9 years old. And at 9, here's how little boys react or act. At 10, here's what you can expect. At 11. And I was shocked at how bang on those predictions of how a child would act can be. And it really helped me both with, being a big brother, but also parenting, going, oh, my kid just said, I hate you, Dad, because you won't let them go out that night, but they don't really hate you. And you can't take it personally. You have to understand in their brains, this is what they feel at that moment. It's appropriate for the age. And the same with investing, right? If you understand that the markets don't hate us right now, they're just going through this phase, they're correcting. And as long as you follow and do the right things, you're going to be okay. That's kind of, you can't overemphasize how important understanding the game of investing is, the journey.
Yeah. For sure. Yeah. Like we were talking about, there's that human element, which is so important. Because we can't all just
I think it's the biggest one. Yeah, I think it's the biggest element, and I think that having worked with clients and seeing which clients would have succeeded without my help and which wouldn't, the biggest thing I think is the behavioral aspect of it.
Mm-hmm. That makes sense. Yeah, because you could know the data very, very well.
Yeah,
but if you're not going to make the wise decision, then well, how useful was that data to you really when you're going to go off and go rogue anyway?
I guess it's like anything. Let's take a scenario. You want to lose some weight. You can understand what it takes to lose weight, but it's your behavior that will either make it successful or not. And you can understand what being a good investor is, but if you don't have the behavior to follow through on that, it's not going to help you.
That's great. Wonderful. Well, thanks for sharing the wisdom with us. I don't know if we mentioned your age, but you're in your 60s now, right? So I should have.
Yeah,
I'll mention that in the intro just to give some context. So you have the experience over the decades here. So it's great to hear that.
I know this is a podcast, Cornell, so you can't see my gray hair, but yeah, there's a lot of experience in my hair. Both as an investor, an investment advisor, but also as a human being. And I have the benefit of hindsight to look back.
Okay.
And, I think I said this on a recent YouTube video that we did. I said, one of the things that you have to learn early is that you never know everything, right? You think, okay, I've learned a lot, and you do have a breadth of knowledge, but there's always something that'll come around the corner. So the day that you figure you've got it all figured out, that's a bad day. So keep learning.
Reminds me of probably one of my favorite, most quoted Socrates quotes, where the true wise man knows that he is not actually wise. I'm paraphrasing, but it's basically along those lines, right? So I always try to think of that to be humble. Yeah, being humble and knowing that you never know everything. There's always more to learn, and a true wise person is always open to that. Yeah,
I do like investors to be successful. I mean, I'm not a big fan of investors who think they got it all figured out and go on social media and everybody else is a loser and this is the way you should do it. And it's times like we're seeing now where those people are humbled, and it's a very good experience for everybody to go through.
Yeah. I find the experience has been just having gone through it, like even just the COVID thing. I feel the reason I'm so not anxious now about what's happening, a big part of it is, I've gone through COVID and what happened to the markets there, and and I'm heavily invested during that time. And so just having that kind of in your back pocket as an experience and knowing that you came out alive financially, I'm speaking here, and you held on and it worked out. That really helps. So yeah, I guess for any investors that are just getting into it or haven't been in it for that long, I would say that it does get easier as you go through these storms because you learn that there is light at the end of the tunnel. Have you found the same thing, Mark, where the more you've gone through it, the less the subsequent storms have affected you negatively in terms of anxiety because of that experience?
Absolutely. There is a caveat to that just came to my mind now as you said that, because another stage that people go through, and I want to be mindful of time here, Cornell, but just a quick aside here, another stage that people go through is when they're getting near or in retirement. And even all of these life lessons, it can come back again, a revival of that anxiety because, gee, I don't have a paycheck coming in, or next
Right.
year I need to have X number of dollars. My math says I need this to live off of to generate the income in retirement. So I can't afford a 20% hit or a 50% hit in my portfolio. So whether it's logical or not, doesn't really matter. That anxiety does come back. So you've got that new beginner phase where, wow, I've never been through this before. I hope I'm going to be okay. And then you've got even an experienced investor who goes, yeah, but my life has changed now. And that's where you kind of go down, the IPS I talked about earlier, it isn't a lifetime document. It's a live document. And, it evolves as you evolve at different stages of life as well.
That's a great point. Yeah, we talked before about the accumulation stage versus the accumulation or preservation stage. And yeah, so it seems like you get so many variables change when you shift to that decumulation phase that there's some new level of learning and experience that has to happen there before the anxiety starts getting removed a little bit, it seems. Yeah. I hear you. I went through that as well. So I know what you mean. Yeah. Awesome. Well, Mark, thanks so much. Tell us more about where we can learn more from you and any other educational resources that you'd like to highlight.
Well, absolutely. Well, I guess sort of the most prominent one that my son Brandon and I have, we have a YouTube channel here in Canada. And, it's finance related, it's investing related. We cover a whole range of investing type videos, like the gamut. There's hundreds of videos on there now. Brandon started the channel, I would say probably maybe 8 years ago, somewhere along those lines. And then when I retired, I started doing videos with him. You can go look up playlists if there's anything particular. So that's probably our most widely visited source. On that note, I also do have a weekly newsletter. It's called The Pulse. And it's basically a weekly wrap up of top economic stories. Now, I know that, the economy isn't things that it's not as exciting as, what NVIDIA's doing or what Tesla's doing today. But I kind of look at it like a weather forecast. If you're going to go out in the weather, having a forecast of what's going to happen or what's likely to happen, do you need an umbrella? Do you need sunscreen? That's really important. I think as an investor, understanding how the economy works as well and whether interest rates are expected to go up or down, those types of things, that's important. So I do cover the top stories of the week there. I usually pick 4 or 5 of the top news stories as well. And that's sort of the educational part. I try and keep it light as well. I always have a weekly poll and, the top performers of the week, that type of thing. So it just sort of lightens up the newsletter a lot. And yeah, I started maybe a year and a half or a couple of years ago now, and I'm actually really pleased at, how involved people are. So that's something there. And then, the other thing I guess I'll mention here is our, I have a very, very small podcast. I'm talking to, one of Canada's biggest podcasters here in the space, but we do repurpose our YouTube videos and put them on a podcast as well. If people are in their car or whatever, shouldn't be looking at a video, they can listen there. Mm-hmm. But the heart of our company as well, Cornell, is our Investing Academy. And this is more for DIY people who really, really want to get serious and learn about the, the industry or the game in general. It's a series of self-paced investments, it's a series of self-paced lessons. There's a Discord community where you can ask questions from fellow investors. Myself, Brandon, and I are always on there checking back there. So no question, it is definitely an investment in both time and money. But for people who are serious about learning, it's an excellent resource there. So you check that out. Yeah, that's kind of where we are aside from this podcast.
Sounds good. So it's Beavis Wealth is the official name of the YouTube channel, right?
YouTube channel is Beavis Wealth. Yeah.
Yeah. And that's, so just for the listeners, that's definitely one of the biggest Canadian specific investing personal finance channels out there. At one point, I don't know if it's the biggest. I think it was the biggest. Maybe it still is. I'm not sure, but like easily one of the biggest. I don't always compare the stats amongst all the YouTube channels, but but I know you guys definitely have one of, if not the biggest, YouTube channels specifically for Canadians when it comes to personal finance. So that's awesome. And then for the other things you mentioned as well, what should people Google, or the URL or anything like that? So if they want to look it up,
the best starting place, Cornell, if you go to beaviswealth.com. then that'll take you, if you want to click on the newsletter link there, or if you want to go to learn more about the academy, everything's on there. It's sort of like a dashboard, I guess you would say, for the various things that we do.
Awesome. Well, that's good. Well, thanks for coming on. And yeah, definitely for anybody that maybe didn't listen to the previous episode, we had one, or I guess it would have been 2 episodes ago by the time it gets released. But yeah, we had a whole session where Marc was there, his son Brendan was there as well, and we had some of the other major
Canadian YouTubers,
influencers, in the personal finance space in Canada. And we were talking about our different investment styles and how each of us invests and what we like to purchase and how we think of it and the pros and cons of the different styles. So definitely check that out if you haven't already. It's been one of our most well-received episodes, I would say, ever, definitely in the past years. So yeah, really, really great to get some different perspectives on the different ways to invest and the pros and cons of each so that you can find the best one for you. So yeah, definitely check that out. That's all available for free in your favorite podcast player, YouTube as well. I know we also did the video version on your YouTube channel as well there, Marc. So it's there too for people that want to actually see our faces. So thanks for coming on and sharing your wisdom with us. It's like I said, it's rare to find someone that's been in the industry for this long and is retired now as well. So you have those decades of experience as well. A lot that we can learn from people like yourself, and you're quite rare with that kind of level of expertise and wisdom and experience. So thanks again, Marc, for coming on. Until next time.
Thank you so much for the invite, Cornell. It was a pleasure.
Awesome. And I'll be sure to link. Thank you. Yeah, and I'll be sure to link out to everything in the show notes so the listeners can check that out as well for those links. But Beavis Wealth is basically the name of the YouTube channel and the website as well. So that will be fairly easy to find as well. You'll see it at the top of the search results for sure. It's definitely quite substantial. So have a good one, Marc, and thanks again for coming on. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well. I often get asked what I personally invest in and why. So to answer that, I created an in-depth guide to explain what specific investments my wife and I held and continue to hold as we moved through the accumulation phase, where the focus was to grow our investments as quickly as possible, and then transitioning to living off our investments in our early 30s when we hit our financial independence number, and the focus shifted to living off our investments in a sustainable fashion long-term so that we don't run out of money in our early retirement. These investments are literally where we have almost our entire net worth apart from our house, and is what we are living off right now. So I figure at the very least, you'll learn about some great investments to consider for your own portfolio. I explain why I pick those, and I do provide the names and ticker symbols of the specific investments so that you can look them up yourself. The guide is actually a live Google Doc that I continue to update as things change, so you can view it anytime to see what I'm currently holding and why. I get it that it can be super overwhelming with the thousands of ETFs and other investments to choose from for us Canadians, and so I hope this will make things easier and less stressful for you. You can access the live Google Doc at any time by signing up for free over at buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.